Another outstanding surfer from Hawaii, Fred Hemming. Fred only stands up on alternate Wednesdays, but when he does, he really wails.
I'm going to be looking at the Forex trading strategy that's used by the real pro traders. It's a long-term trend following, and it has a whole host of advantages. If you want to be a trend follower, you'll find that it's very simple to learn a strategy that can make money. The logic is easy to understand and have confidence in. It makes big profits, and perfect for the busy person. It only takes around half an hour a day, 30 minutes to execute your trading strategy. Very few retail traders consider this method of trading. But here I want to go through why it's such a great method, how to basically trend follow correctly. And the real key to success with it, which is understanding the difference between stop on initial equity and open equity, which most traders do not understand. But if you do, you can be making big profits at 500 pips, 1,000 pips or more on single trades. So we'll come to all the trend following basics in a moment. I'll just actually introduce the video there, first of all, with a clip of some surfers. And the reason I did that was Ed Sakota, the great trend follower, once said, if you want to learn about how to make money in the markets, go to the beach, study waves, and look at surfers. And I thought the analogy was very good and makes it very easy to understand trend following. And I thought I'd work it through the video as I go through this analogy. So first of all, let's start off with long-term trend following. What do we mean? How long should the trends be that you're looking for? Well, I would say that probably a minimum of a week to probably about 3 months, something like that would be the typical average for me. But trends can go on for longer, 6 months, sometimes even a year. The key is to stay with the big trend and not get out of it too early. So how do you find these big trends and how do you get into them? Well, the way you find them is to look at the longer term charts, so the monthly and weekly charts, find those big levels. Then go to your daily charts and come in on a breakout, okay? It's, you can be very simple with your entry, just a breakout, and get in the market, and then you'll have your longer term charts to give you your objectives, targets, etc. Now, when you come into trend following positions, a lot of people think you have to take more risk than you do in, let's say, shorter term swing trading. This isn't so, actually. When I come in for a trend following positions, stop loss of 100 to 200 pips. If I'm doing swing trading, it's going to be at least 100 pips. I'm not taking a huge amount more risk on the way in. You don't actually have to take a lot of risk on the way. It's a myth, okay? Once you're in the market, this is where you actually have to understand the difference between stop loss on initial entry and on open equity, okay? Let's take it, you get into a move, suddenly that trend starts to go for you, you're up, say 300 pips. What will most traders do? They'll get their stop and they'll literally jack it up right behind the price, and then they'll get bumped out of the market. Okay, they'll have a few hundred pips, but then they'll see the trend go on the way they thought and make 500 or 1,000 pips or whatever it is, and they're not in. And this is the problem for most traders, that they cannot hold big trends. Once they get a big trend in the market, they see it just pull back a little bit against them. They want to get in there and snatch it, take it before it gets away or protect it. So that they never ever can hold the long-term trend. So how do you hold the long-term trends? Well, if you actually go and look at a chart, any chart you want, just study charts going backwards in any currency pair you like, you'll see how big the long-term trends really are. You'll also see the size of the retracements, okay? Once a big trend is in motion, you're going to get retracements of a few hundred pips before the trend goes back the way it was going before. So you've got to be prepared for that. And I've always found that once I'm in the market with my stop, okay, my stop might have been 200 pips on entry. When I'm in an open position, it might be 300 pips back from where the price is. And you actually have to understand that if you're looking for big trends, you have to give that market room to breathe, okay? And focus on the long-term trend. In surfing, surfers when they get big waves, they will surf them for all they're worth. They'll have to wait around for them sometimes. They might be, falling off small waves, whatever. But they're always focused on that big wave. And that's the aim of trend following. You're always focused on the big trend. Okay, you can get a lot of disappointments when you try and get into big trends. They don't go the way you thought. You get stopped out. You have to wait again. But you catch one big trend, it pays for a whole lot of losers and will give you a massive profit. And I found that there's many trend followers I know who won't be trading very much at all, maybe a couple of times a month, but they make massive amounts of money because they can stick and stay with those big long-term trends. Just like surfers know the big waves are going to come up in the ocean at some point, basically Forex traders know the same. You're going to get big trends somewhere in the currencies, and it's your aim to just get in on them, hold them. And when a surfer is surfing a wave, he's going to stay with that wave as long as possible. And I think you've got to basically do the same in Forex trading. If you're in a big trend and the trend is showing that it's continuing from the chart, you don't want to come off it or come out of it. You just want to hold in there. Forget about the money you're actually making. If the chart looks good, you could make more money. So you stick with the trade with discipline and ride it. Now, if you actually want to do trend following, you'll find it is very, very quick to learn. You just need some long-term charts, simple breakout system. But the real key is just understanding where to place your stop when you're in an open position. It's got to be close enough to give you protection, but far enough away so you don't get hit by those retracements. So how far away should it be? I'll give you an idea of the way I do it. I always view the first level of support in a big trend to be normally somewhere around the 20-day moving average. You don't have your stop just behind that level, because that's where the price will naturally gravitate back to, get some noise or whatever. The trend will either reverse back up or come back even further. You want to be out the way of that area. Okay, you want to have your stop at the next major level back, and I normally find that's behind a 40-day moving average. Pick a level of support around there in a a big trend, and you'll find that will normally give you protection. So it's a real patience game when you trend following. You have to be very, very patient. Always focus on the longer term. Those retracements are natural. Don't worry about them. They just happen. So you just basically ride them out. Just ignore them. And the beauty of trend following is those trends are always going to be coming up in the market. And it's a very sort of, how would I put it, easy way to trade in terms of the amount of time you're spending looking at prices. You have to look at them once a day when you're trend following. You've got your stop in, you're focused on the long term. That is it. And the professional traders use this strategy. Most retail traders want instant gratification, or they think they can pick tops and bottoms, and they ignore trend following. But if you actually look at trend following, you'll have a strategy that pro traders use, which you can use too, and make a lot of money with it. So thank you very much for watching me. Take care. Have a good day.